G'day guys, and welcome to another YouTube lesson. Today we're going to take a look at finance, and we're looking in particular at key influences of financial management. As I've said each time, we've got our four business functions: operations, marketing, HR, and presently finance. Inside finance, there's four subtopics, and you might get sick of hearing me say this, but that's good. Okay, once you know it, I might stop. I probably won't. I keep doing it just to make sure you get it. The four subtopics in finance: role of financial management, influences or impacts of financial management or on financial management, the process of financial management, and strategies of financial management. So we're looking at two very important influences in financial management, the two last parts of influence on financial management. And they're both reasonably difficult. The last one, global market influences, that was part of the 2018 HSC essay. So this is important stuff. Each of these you can see as future potential essays. The first influence we're going to look at is influence of government. Does the government impact financial management? And we're looking at ASIC, Australian Securities and Investment Commission, and also company taxation. Now, both of these impact on financial management of a business. And how do we measure or evaluate that impact? 5 key ways: profitability, efficiency, liquidity, solvency, and growth. Do they have an impact on a business in any of those ways? They sure do. The second influence on financial management we'll address today, and the last influence in finance, is global market influences. And they have 3 parts to it: the economic outlook, the upturn, downturn in the economy, the availability of fund, the availability of a business to be able to source funds, and interest rates, global interest rates. Well, let's go back to that first one, the influence of government. Okay, this refers to the decisions that governments make and how they can impact or influence a business. Now, the first way that this can happen is via fiscal policy. Fiscal policy refers to government revenue and spending. So government revenue through taxation, and then what they spend on welfare programs, all right, and other additional programs. And we would like often, as young economists, to run budget surpluses for most of the time. That often does not happen. If the government increases the company tax rate, then it would generally have a negative influence on the business. And so traditionally we've had in Australia, certainly over the last few decades, 30% company tax rate and business tax rate. Now, depending on when you're viewing this YouTube clip, that's changed. Okay, it's no longer 30%, and we'll look at that a little bit later on. Okay, it's gone down though to 27.5% for certain businesses. And the other way that the government can influence the business is not directly, but indirectly through the Reserve Bank of Australia. By raising the overnight cash rate, the interest rate, it's called monetary policy. Be clear, and economic kids are going, oh, I don't think so. They should be. Monetary policy, RBA, that's not the government. They're separate institutions, and they're on purpose separate. But they are part of, an external agency that can have major impacts upon business. Fiscal policy through the government and Reserve Bank through monetary policy. You're right in saying they're not exactly part of the government. In fact, the government can't tell them what to do, the RBA, but they both have big impacts on financial management of a business. Now, ASIC is Australian Securities and Investment Commission. ASIC looks after companies and making sure that they follow the Australian Securities and Investment Commission Act 2001. It's very important, if you want BN6s, that you have this type of legislation on hand to demonstrate your knowledge to the market. Now, the major role of ASIC is to make sure that companies are not acting illegally in relation to things like insider trading, falsifying or giving misleading financial statements, making claims that a business is generating greater profits than they are. Now, another governmental organisation, which is important, but it's not part of the syllabus. It's still important enough that I want you to mention it, is APRA, Australian Prudential Regulatory Authority. It's there to make sure that the financial services company are following the law. Okay, not businesses in general like ASIC. They haven't been very good. If you've been watching over the past months, year, and longer if you're watching this, in the future. Okay, APRA have not been very strong at dealing with our banks, and they're trying to toughen up this watchdog to make sure what the banks were doing doesn't happen again. They're making sure the banks and NBFIs, APRA, are not using deceptive and misleading advertising in relation to interest rates and other loan conditions, and not acting in an unethical way. Now, these are influences because companies need to follow the law. It impacts, it influences them. ASIC, okay, they need to follow that Australian Securities and Investment Commissions Act 2001. If they do not, they can face hefty sanctions, punishments. So I guess if you like to comply with the law and act ethically, it's a positive influence. If you don't, it's a bad influence that has additional compliance costs that you don't want to pay. Now, we mentioned before company taxation. Let's delve into that a little bit more and how it influences a business. Company taxation refers to the rate a company or business is taxed at by the government. Currently, as of the 5th of November 2018, the company tax rate is set at 30%, or 27.5% for small businesses that have a turnover or sales, same thing, under $10 million. If you're over that, you're paying the 30%. Now, if it was to get higher, then it would be seen as a negative influence for business, because if they're paying more in tax, that means less net profit after tax. So that's not so good for a business. It doesn't meet that profitability objective, and efficiency is higher. Well, efficiency ratio would be higher, which means the cost is worse for the business. Vice versa, if there's a decrease in tax rate. So if fiscal policy means the company tax is reduced to 20%, as some would argue, I don't, but as some would argue, then that would be good for business and for profits. Would the average worker see that benefit? That's where, does a trickle-down effect always work? Not so sure about that. Now, global market influences is the next influence that we look at, and it includes three parts: economic outlook, availability of funds, and global interest rates. All right, so when we take a look at economic outlook, this refers to the boom and the bust, okay, in the economy, both domestically and internationally in this case. So how does this impact this economic cycle and the outlook of the economy? How does that affect businesses? What do I always say? It depends. If that's what you said, well done. It does depend. There's a positive economic outlook if the economy is going awesome and there's a big boom, then that's a positive impact on business. Why? Because more people are spending money, there's more confidence in the economy, greater sales, greater profits, greater growth, profitability, okay, and so on. It's meeting those objectives. Solvency, loans can be paid down, so your debt is lower compared to your equity, all right? And therefore, a business has better solvency as well, potentially. On the flip side, though, if there's a recession, a major downturn like the GFC in the economy, it has a very negative impact on a business financially, and those objectives are the opposite of being met. All right, cash flow shortages, greater loans need to be picked up, so debt to equity, debt's higher, not so good, and so on. Profitability is reduced. All right, so it has a negative impact on the business. And so I'm linking it to those key financial objectives. Almost there. Availability of funds is another global market influence, the second of the three. This refers to a business's ability to be able to gain access to funds, to loans, to be able to meet their current debts or to expand their business. And you might go, well, if the funds aren't there, if I can't get a loan, Who cares? Is that a problem? The answer is yes, because most businesses, like most homeowners, most people in society, we're all in debt. Yeah, I'm not so much. I paid off my house, but anyhow, most people are. Most businesses are. And therefore, if all of a sudden banks said to businesses, all right, you got $1 million debt. Sure, you're making $10 million in profit each year. You got a $1 million debt. We want you to pay that right away. Even though a business has the potential to be very profitable, if no one gives them a loan to pay that $1 million debt to that other bank, they'll become insolvent. And that's what happened a bit with the GFC. Some businesses were making profits, although the economic outlook changed, so their profits dropped and they may not have been. In the long term, though, they would have been sweet. But they became insolvent because banks called in the loans that they had out for them. And so if there's not enough funds available, then it really can mean the businesses can't source funds to grow. They have to pay back those loans, and they don't have the money to pay for it at that point in time because they've got, loans out, mortgages and so on. And that can see the end of a business. So it can be a very negative impact if there's a lack of available funds, a source or pool of funds to be able to invest. But availability of funds, is that good or bad? It depends. If there is a large availability of funds, especially domestically or globally, I suppose, then a business has a reverse effect. They're able to take out loans, to grow. If there's huge availability of funds, interest rates may well be lower. All right, and therefore a business is able to meet the profitability, growth objective, solvency is not such an issue, and so on. Now the last one we're looking at with global market influences are interest rates. This refers to the rate of interest a business can obtain for a loan. Now, interest rates, are they good or bad influences? I'm not going to say it again. You know what I'm talking about. Starts with D. If interest rates are high, then it has a negative impact on a business, as the cost of borrowing money is higher. Vice versa, if the interest rate is low. And I want you to think about that. It's all easy to say it, but you get it. If interest rates are high, then a business, if they're lucky enough to have a loan, there's the availability there, they're going to have to be paying more to what we say service the loan to be able to, if it's $1 million loan, 10%, $100,000. If it's 50%, maybe if it's 50%, it's now $50,000 a year to pay for that loan. Or sorry, if it is $1 million, it's now $500,000, $500,000 to be able to just pay the interest on that loan. So that interest rate, the lower it is, the better it is for business, because it doesn't cost as much to pay the interest. If it's a higher level of interest rates, then even the business can gain access to the loan. It's going to have a big impact on a business. Less profit, won't be able to grow as quick, maybe issues with cash flow, with liquidity, because they're having to service that loan, and even solvency could become an issue. That could become a problem too. All right, guys, thanks for listening, and we'll move on to the next part of finance next lesson. See you later.